If you have over $200,000 sitting stagnant in your bank, retirement account, or home equity, then you're literally losing money. On this show, you learn how to get that money working for you consistently and conservatively. Learn to grow your nest egg with your host, Shawn Winslow. Let's dive in.
Welcome back to another Finance Friday episode. I'm your host, Shawn Winslow, and this is the Multifamily Money Podcast. What's going on, everybody? You know the drill. Every Friday, we're coming at you all things personal finance because it's not what you make, but what you keep. And we want to keep as much as we can so we can get that compound interest, the eighth wonder of the world, so we can achieve the goals of our dreams. We can all make this world a better place. And today, I actually have a guest on Finance Fridays. I know usually it's a solo run where I'm talking about something that I want to share with you, either something I've done or something I've learned about that I want to share with you all. But today, I've got a guest, someone I'm interviewing. And we're talking about something called note investing. So what is note investing? I'm going to let our guest really explain what that is, but essentially think of it as you being the bank. You know, you go buy a house, you get a loan from the bank generally, right? Generally, you don't pay all cash. So you get a loan from the bank, you bring the remaining down payment, maybe 10 to 20%, and the bank, funds the 90 to 80%. Well, what happens if you're the bank that's bringing the, say, 80%? And you collect the interest and principal payments? That's pretty interesting, right? There's got to be a reason why there's so many banks out there and why banking has been around for centuries. There's got to be a reason, right? And why wouldn't you want to reap some of those benefits? So our guest, Fred Moskowitz, he's an experienced speaker, author, and educator. And he also has a book called The Little Green Book of Note Investing. You get that anywhere books are sold. So check that out. We'll put a link in the show notes. But Fred comes on and explains his experience, right? How he was in W-2, relied on that W-2 income, and then one day realized that, not only could you lose that job and lose that income one day, but you also don't have flexibility of time. Say you want to take care of a newborn. Say you want to take care of maybe a parent that's older, or you just want to go on a trip that's longer than normal. It's hard to do that with a W-2, right? And so that led him to look at alternative investments, alternative ways of making income. So he could have that time freedom along with making more steady and reliable source of income. And that's when he came across note investing. So we dive into all things note investing, what it is, how you can get into it, and the benefits. So without further ado, here's Fred. Hey, Fred, welcome to the show.
Hi, Shawn. Thank you for having me on today.
You're very welcome. Thank you for taking time out of your busy day. I'm excited for this one. Listeners, as I mentioned in the intro, we're going to be talking about note investing. But before we get into that, Fred, why don't you just tell the listeners a little about yourself, who you are and what you do?
Yeah, thank you. Shawn, I'll share a little bit about my background, and this will help provide some context. So I came up having a very long, successful career. I was working as a computer engineer, and I spent many years working at different tech companies and startup companies. And what happened was I experienced seeing my entire industry get flipped on its side from the bursting of the dot-com bubble, and that was immediately followed by the September 11th terrorist attacks. And so I realized that I was way too dependent on the income from my job. And I loved the work I was doing, but my job always had all these circumstances completely out of my control. And what I learned was that no matter how talented of an engineer I was or how valuable of an employee I was, the bottom line is that if things were not going well at the company or in the industry, I could quickly lose my job through no fault of my own. And so from that, I came to the realization I needed to start building other sources of income so I wouldn't be so dependent on that paycheck for my job. And I turned to alternative investing, the whole concept of buying and building assets that generate cash flow for you. That was very appealing to me, and that's what I was looking for. And so I started out with real estate investing, built up a rental portfolio, and after a number of years, I started to get involved in note investing, which is where we invest in the debt side of all the real estate transactions. And what I loved so much about investing in notes in debt is that we're investing in an asset that's secured by collateral, right? The other detail was that you could purchase them at a discount. And the third was that could earn a really high rate of return. And so when I saw all of that together, I found notes very appealing and have grown that business. And that is now my main focus.
Oh, that's awesome. I feel like that can resonate with a lot of people. The whole not wanting to have to, the W-2, like relying on that, not wanting to have to rely on the W-2 and that income because,
yeah,
we're seeing it now with all the layoffs. You're valuable one day and then not the next.
That's right. That's right. Things can happen. Or here's another thing that happens is, what if you want to take time off for family reasons? Let's say maybe you have a newborn that you want to spend time with and help care for. Or what if you have an elderly family member or a family member that's sick and you need to spend time caring for them? What if you could say, hey, I'm going to take a leave of absence, or I'm going to take 6 months off from working so that I can focus on these family things and do that and not have to worry that your income is stopping. And so isn't it all what we all want in life is to have options and have flexibility? And that's what this allows. It allows for having a good financial foundation so that you can pay your living expenses off of your investment income. And when you're in that position, all of these options open up to you, and it's the best feeling in the world.
Yes, and that resonates with me, Fred, because when I was looking to leave my career in finance, I decided instead of just looking for the next job, I wanted to look for a job that would support the life I wanted. And the two things I wanted, main things, were flexibility of time and calendar, and then money, obviously, to support the things I wanted to do and the people I wanted to take care of. And so that really resonates with me because those are the two things that I feel anyone needs to really accomplish anything they want to. And so I want to dive into this. So you briefly mentioned what note investing is, but if we go a little deeper, what it is, what it entails, and then if you wouldn't even mind, how you came across it, or how that any individual could come across it and get into it.
Yeah, absolutely. So let's break this down a little bit. What is note investing? I find that a lot of people, they know about investing in real estate, right? It's a great asset class, super powerful. And there's all different types of real estate: single family houses, commercial property, multifamily property, vacation rentals. And with note investing, this is where we start talking about investing in the paper, the notes and the mortgages, which are associated with all of those properties. And what I found is that it's a really interesting part of the real estate business, Shawn. But for some reason, a lot of real estate investors, they don't pay any attention to it. And most investors, when they think of a note and a mortgage, they think about it from the perspective of being the borrower and not as being the lender. When you get involved in note investing, it allows you to step across the aisle and become the bank. And so you transition from being the one making the monthly payments to being the one receiving the monthly payments. And note investing, it's a great way to increase the predictability and stability of your cash flow. And so the area I like to focus on myself is buying existing notes on the secondary market. Other strategies are where this happens a lot in real estate, where an investor sells a property with owner financing and they carry back a mortgage and creates one. That's a different strategy. But the one I like is buying on the secondary market. And as far as how to get involved, there's several ways. So the first way is to go out in the secondary marketplace and buy notes that exist already and build a portfolio that way. Another way is to invest in a note fund, which is professionally managed. And the fund managers, they'll go out, they'll raise capital from investors and then pool that money together. And then they'll go out and buy notes in bulk quantity. And the nice advantage there is that the fund managers are able to negotiate better pricing. They're going to have better access to notes because they're buying in larger value. So, and think of this: when you're buying and building a portfolio of notes, that's active investing, and then investing in a note fund, it's passive investing, where you don't, as the investor, there's not really much for you to do beyond the initial due diligence of evaluating that fund. Once you invest your money, it's pretty much on autopilot, and you don't need to, you don't have any additional ongoing work. And so those are the different ways to get involved in note investing.
And so where do you find this secondary market? Where would someone go?
The secondary market, it exists at many levels, all the way at the top from Fannie Mae, Freddie Mac, selling off every quarter their gigantic pools of mortgages, which are then bought by financial institutions, very large hedge funds on Wall Street. And then over time, they will securitize the loans, or maybe they'll have loans that have been securitized and they're breaking down the bond, and then they'll sell off all the loans. And those eventually are sold off in smaller and smaller sized trades to note funds and individual investors. And so how to find that for us as individual investors, a lot of it is through personal relationships, through word of mouth. You meet other note investors, you meet sellers of notes by attending events and conferences in the industry. But everything is done through personal relationships. So for us that are active in the industry, it's something that it's the most important skill, is getting good at building and nurturing relationships.
Yep.
Yeah.
So to make it clear for the listener, so it's not like you can log on to your Fidelity account and make a trade. This is about, old school person to person business and building that network.
It is very, very much so.
Yeah.
Very much so. But here's another thing, Shawn. If you go to any RIA group around the country, there's always a couple of guys and gals that do notes.
Okay.
They buy and sell notes. Not many. It's really a niche investing area, but there's always some. So if you're involved in a real estate investment group, look for the folks. There's a couple you can ask around. There's always a couple that they have notes, or they sell properties with owner financing and all those things, and create relationships there. That's where it all starts. And so this is something that anyone can do. Now, if you go and attend a note conference, a note investing event, then who's going to be there? It's hundreds and hundreds of note investors. And so there'll be a lot of people that you can talk to about that.
Yeah.
But another way for someone getting started, I always recommend check out investing in a note fund, because you're going to start to build a relationship right there with the people operating that fund. A lot of times funds at the end of the year have to sell off notes, and so obviously they will go first to their investors that have expressed an interest in buying notes individually, and there could be some opportunities that open up there. That's
interesting.
Yeah.
So Fred, just to kind of also paint a little picture for everyone. So that when you get a mortgage on your home per se,
yeah,
and it's consistently changing servicers, this is what's happening, right?
Yes, exactly.
Yeah.
And remember that a lot of loan originators, their business is to originate loans. And so they will create a loan, they'll underwrite it, get everything approved. And always this happens within 3 months after closing or 6 months, you get that letter in the mail saying, "Dear Mr. and Mrs. Homeowner, please be advised your loan is being sold. Here's the contact information for the new lender, and please start sending your payments to the new lender starting next month." And that's why the loan got sold. And then that loan originator, that financial institution, they recoup their capital, and now they'll turn around and write a new loan. And they make a very small margin on each loan, but because of the velocity of the way they do this, it's high volume. And that's how they make their money, and the different fees and points at origination and all that stuff that they do, and processing the loan. But that's how that works. And remember that loan originators are in the business of originating loans. So they're not going to create a loan and then hold it long term.
Right. And do you see with everything that's going on right now with transaction volumes down, will this slow the business down in terms of them selling and obviously creating new loans because the transaction volume's down?
It is down for sure, but remember that the transaction volume had ramped up significantly because of the interest rate environment. I mean, it was a great time to refinance. And so most people that were in a position to do so, they did to take advantage of the low rates. And so things are coming back now to a normal type of volume, although it is significantly less than, let's say, a year or two ago. But in the secondary market, there's always new loans being created. There's always new loans being sold. The real estate market has reduced a little bit in terms of transaction volume, but every day people are still buying and selling homes. They're moving because they have a job change, or they need a larger home or a smaller home, or someone wants to get into a better school district. And so all of this activity is still happening. It's just not at the extraordinary volumes that we've had over the past couple of years.
Yep. And when if you're looking, say you're looking at a note, Fred, to invest in, to purchase, what's kind of the underwriting or the analysis you do? Is it kind of like a loan originator does, where you're looking at the underlying, obviously, borrower, credit scores, income, all that good stuff?
Yes, that's a big part of it. Absolutely. But there's some other details that come into mind as well when you're doing this analysis and due diligence. You're going to want to look at the track record and history on the note. If it's not a newly originated note, then there's going to be a payment history associated with that. So you as the buyer are able to see that and review it. Have all payments been made on time for the past 2, 3, or 5 years? Or has there been a couple of missed payments or late payments along the way? So all of these different things that you look at. In addition to that, you're going to look at the relationship you have with the note seller. Are they reputable? What's their history like and track record? That's very important as well. Also, you're going to look at the regulatory requirements in the state where the loan is, where the property is. Each state has their own requirements, some more than others, around regulation. There might be licenses that you need, or it might be required that you use a licensed loan servicer to handle the servicing of your note. And so you want to know about those requirements up front.
Yeah, those are actually two questions I was going to ask. One, do you need any licensing to do this? And two, is this geography agnostic, or do you actually try to stay out of some areas?
No, these things are state by state. It's state specific. For us, we buy loans nationwide.
Okay. All
over the US. Some investors prefer to stay out of certain states for one reason or another, but we're at a point where we're buying pools of loans. They'll be mixed in with all different states, and when there's a good opportunity to buy loans, we'll buy them.
Yep. And when you're buying, I guess it probably can go either way, but do you tend to buy them individually, or do you like when they're kind of securitized already and there's like a portfolio? Do you get any type of, scale? Well, you obviously get scale by doing that, but do you get any type of, value by doing that? You do.
We will buy individual notes. However, when you buy in quantity, you can negotiate better pricing, and better access to notes. And so that's
probably easier for them too, right?
It is. It is absolutely. It's easier for a larger note fund to sell a pool of 10 or 20 or 50 loans than to do 10 or 20 individual transactions with different people.
Yeah.
And have, different closings and all of that. So it's definitely beneficial for sure.
Yeah. And can we just, if you don't mind, can we kind of just give an example? Say there's, a note with an outstanding balance of 200,000. What would that kind of transaction look like? And how much money would the investor have to bring? And then we can get into, where can this money come from?
Absolutely. So let's talk about your specific example. Let's say it's a $200,000 loan, 6%, 30-year fixed, just to make the numbers easy. So that payment would be somewhere around $1,200, maybe $1,198, something along those lines, a month of a payment, right? And so that $200,000 loan might sell at a discount. So it might go for 180,000 or 170,000 or 160,000. And so if you were to put those numbers into a financial calculator, you're not solving for the 6% interest rate anymore. When the loan price goes down, the rate of return starts to go up. So that 6% could become 7 or 8 or 9%. And these discounts depend on the risk level of the loan. It's like any other investment. If you want a super safe, low risk, you're going to pay more for it. If you're willing to take on more risk, more potential for problems, you can start to earn higher rates of return. And there's no right or wrong answer here. It depends on what you're comfortable with and your risk tolerance as an investor.
Yep. Yeah, the whole risk reward. And we get into a lot of stuff, in the bond market, there's duration risk, all this stuff, right? So it all adds up, and that makes a lot of sense. So from your perspective, you buy that for say 180,000. Is this something that you hold for the long term, or is this something that you would obviously sell off as well?
Yeah, you can do either one.
Yeah.
I know some note investors, they will buy a note that they negotiated a good discount. Maybe the payment history wasn't perfect, but it wasn't horrible either, or property that maybe there wasn't a strong equity position backing the note. Little bit of a riskier situation. So a note investor could buy that note, hold it for a couple of years, let's say 3 years. They receive payments for 3 years on time, right? And then after the end of the 3 years, they can turn around and sell that note. And most likely, the loan balance didn't go down too much, because notes at the beginning of their amortization schedule, very little gets paid down on principal. Yeah. And so it's almost like the note investor, he collected 3 years of payments, and then he can sell the note almost for the same price he bought it for. Wow. And recoup his capital again. Plus he earned 3 years of payments the whole time. He got paid while he was waiting. That's awesome. So that's a very common scenario. What happens over those 3 years? Maybe the borrower got into a better financial position, more stability. Maybe the property value that wasn't strong equity position now has increased. All of these things can happen. And over time, the position improves for the investor. Now, selling a note can happen anytime. The investor can sell a note anytime they want. They're very liquid. If you have a good network of note buyers, you can make a couple of phone calls and have a note sold in a matter of a week or so, and get paid. I mean, where can you do that with property? Takes much longer than a week to sell a piece of real estate, right? And so it's very liquid, and that's a strategy. So I know a lot of investors that will just hold notes as long as they can. I know others that they'll hold them for a while and then sell them and try to buy new notes with. They'll redeploy their capital. And so there's so many different strategies. But the other thing to keep in mind with this, Shawn, is remember that the statistic in the United States, the average life of a 30-year fixed rate loan is 5 to 7 years.
Okay.
Because during that time,
refinancing. Yeah,
people refinance or people sell the property and move somewhere else. And so it's not often that loans get paid all the way through their full schedule. Right.
That's a good point. So what if someone wants to do this, but they're like, hey, Fred, that $180,000, note, I don't have $180,000 in my bank account. What are some other ways they could do this?
Yeah, here's a couple of ideas. One a strategy I love is using retirement account money for note investing. If you have your retirement account, let's say you have an old 401k or an IRA account, you move it to a self-directed IRA custodian and set it up in a self-directed IRA, or even better, a Roth IRA where there's no taxes due at all. And now you can leverage your tax advantage accounts to do note investing in. And a lot of people, especially the circles that I was in when I was working as an engineer in the tech industry, a lot of people that had successful careers, moved around a bunch, had a couple of their old 401k from their prior employer. They didn't move it. A lot of people have accounts like that. And so bringing those all together, consolidating those into an IRA, moving it to a self-directed custodian, that opens up a lot of options. And so that's one strategy. The other one is back to your question about, hey, if I don't have $180,000, because you do need all cash to buy a note. Look at investing in a note fund. Note funds have a lower minimum. Their minimums might be $50,000. That's most typical. I've seen others where it's lower than that, where you can invest as a passive investor. You can get in the business, get involved, start learning. You're working under the guidance of the professionals managing that fund. And so you can benefit from the experience they have and the expertise and the relationships and access to notes. And so that's a great way. And it gives you diversification as an investor, because instead of all of your money being in one deal, one single note, when you're in a fund, your capital is spread out over many notes. It could be hundreds or even thousands of notes. And that really gives good diversity.
Now, and to talk about diversification, do you invest in other asset classes, or is it primarily residential?
With notes, I focus on residential, residential notes. They are, think of the traditional definition of a Fannie Freddie residential mortgage, the 1 to 4 unit property, right? Yep. The reason why I focus on that is because that's what's most available. It's the most common type of mortgage that's available out there, and there's many of them. But I know other investors that focus on commercial loans, or they invest in notes that are hard money loans or bridge loans, or they invest in notes that are business loans specific, right? And there's so many different types of debt, different types of collateral as well. Yeah. But that's the area I focus on, is the residential side.
Yeah, and there's a lot of kind of backstops on the residential side too that are powerful, right? We're talking about people's homes, so unlike commercial where balloon payment comes and it can just a lot of bad stuff can happen on commercial because it's more of a business than actually someone's home. So
yeah, that's true. That's very true. But some people have that specific type of expertise.
Commercial,
yeah, and nothing wrong with it. It's just a different skill set. And so for an investor that maybe they come from that background and they know that, it could be great. I mean, I know investors that buy loans it's aviation debt, right? That's a whole nother world. Yeah. But with the whole rise in private aircraft being sold, there's financing for that. And so notes are created, same thing, they're sold. There's notes on construction equipment. Think of your local contractor in your city or town, the paving company or the excavation company, and they have all that equipment, the bulldozers, the backhoes, and all that stuff. Most of those are bought with financing or equipment leases. It's all financing. And so if you have that expertise and know about those things, you can look into buying those notes as well.
Yeah, there's so much out there in the note space.
Yeah,
it's really interesting. And I think one thing I forgot to mention or ask is, like, this is all great, but you're essentially being the bank, right, Fred? Why would someone want to be the bank?
You are. Why would someone want to be the bank? Yeah. The banking and lending industry, it's been around since biblical times, right?
Yeah.
And banks have figured out long ago that they would rather be a lien holder on title rather than to be a property owner. Mm-hmm. And remember that your investment is always backed by collateral. So there's security behind your investment. And no matter what happens, if the market changes or borrower defaults or anything like that, you're always protected. And title cannot be clearly conveyed without addressing all the liens on the property. And so that's a really strong position to be in. And it's a great way for an investor to earn cash flow and income without having to have the responsibilities of maintaining and managing a property or the liability. There's no liability for lenders. It's all on the property owner.
Yeah, it's powerful, right? Because when I talk about capital stacks in our deals, right? You talk about a preferred return to equity. Yeah, that equity's getting paid first before any equity, but that's it, right? The lender comes first.
Yeah, always.
You always want to be the top of the capital stack. So if anything was to happen, a property gets foreclosed on, whatever money is made from that foreclosure sale goes first to the lender, the bank. Right. That's why it's powerful. And most of the time, equity sees very little or nothing at all. So it's powerful. And I think to your point too of, personally, I'll be transparent. I've never done note investing. I come from the finance world. We were considered a credit fixed income shop. So I get the bond world, but I've never invested privately into the note space, but I see the power in it. You want to be the top, of the capital stack. And I think to your point, it doesn't hurt you to start off by getting into a fund first, just to feel things out, right? Maybe someone that has a little more appetite for risk could try to do it themselves at first, but I think for most this is obviously not financial advice, but for me, I feel that makes sense. And so where would someone find a fund?
Yeah, it's the same way you would find notes. It's through relationships.
Okay.
So getting out there, building relationships with people in the industry, and that's how you learn about opportunities. It's like any investment, right? You're active in the multifamily space, and so if you wanted to find deals, what do you need to do? You need to build relationships with brokers and property owners, and go to conferences and events where there's focus on the multifamily industry. And that's where you're going to be in a room full of hundreds of people, and you could find your next deal or your next business partner or the next opportunity. It's the same idea for sure. But I think it's really what you said is so true. For someone that's starting out, a note fund is a great option, or someone that wants exposure to this asset class, but they don't have time because they're a busy professional or they're a business owner focusing on their business. You focus on the areas of excellence and expertise that you have. And so investing in a note fund is a great option. I speak with investors all the time. They come to me and say, "Hey, Fred, I love the idea of note investing, but it looks like there's some risks and pitfalls, and it takes a lot of time and effort." And so I always say, look into a note fund. It could be a good fit for you, instead of starting out by investing in individual notes and building a portfolio. And I've seen many investors start out as a passive note investor, and then over time they start to meet more people, get more comfortable, and then they transition into active investing and building their own portfolio.
Yeah, I've seen the same thing in the multifamily space too. People get in as passive investors, get more comfortable, and then to your point, network, meet more people, and then they feel comfortable and they go out and do it themselves. And to me, that's a great way to learn, right? Because you're essentially getting paid to learn, right? Because at least hopefully you're making a return, right? And you're getting paid while you're learning. So
exactly,
I agree with you. But is there anything that I missed that you'd love to talk about note investing? Because this is on the newish side to me as well. So I want to make sure I didn't miss anything.
I think we covered a great deal today. And, I love, again, thinking about using retirement account money for note investing. Something I forgot to mention with that I'll cover briefly. Note investing is an activity that generates a lot of tax liability. It's not like real estate where you have depreciation, you have deductions and all of these things. With note investing, all you have are interest income and capital gains, and that's it. Yep. And so it generates a lot of tax liability. And so if you're able to pair that together by doing it inside of a Roth IRA, for instance, where there's no taxes due at all, it's powerful. Like, imagine investing and profiting at a high level and not having any taxes coming from that, any tax liability. So it's a great strategy. I always encourage investors to look into that.
Yeah. Hey, compound interest is the eighth wonder of the world, right? So
it is.
If you can keep more of it in your pocket to grow, that's better. And
that's right. It leaves more money for you to invest with.
Yeah. And it'd also be tough if you live in a state, which I currently do. They're about to change the tax law here, so it'll go away eventually. But currently they're is dividend interest tax on top of normal tax. So that can hit you too. So yeah, that's powerful. Keeping it in a qualified plan where it can grow tax-free. And Fred, we were talking about this before we hit record. It's just sad that a lot of people don't know that they can use their retirement accounts to invest in alternative investments, from note investing, real estate, gold,
private lending. There's so many. You can invest in private equity as well. Yeah. Right. You always hear, it's funny, you always hear stories in the news media anytime the government's looking at doing something with Roth IRAs. You always hear these two examples of Mitt Romney, how he has a multi-million dollar Roth IRA. Right? Yeah, and Peter Thiel, they invested, their deals were investing in private equity. They invested in shares of a private company that eventually went public and hit it big. And because they did it in a Roth IRA, there's no tax due at all. Yeah. And so if you have an IRA, a retirement account at a traditional custodian, the only thing that they're going to allow you to invest in is retail Wall Street products, publicly traded companies, and mutual funds, and that's it. Yep. And if you want to invest in real estate or you want to invest in notes, they're going to tell you you can't do that. You're not allowed to. And it's not because the tax code doesn't allow it. It's because their internal guidelines don't allow it.
The money's got to stay in the house, right?
They want it to be invested in their own products and things that they're involved with. And so if you look in the tax code, the tax code allows for self-directed retirement accounts. It always was there. And it's just that you have to go to a special custodian that allows for this. And there's a handful of good ones across the US that do a nice job. And they will allow you to do these more creative deals for sure.
That's the power of marketing, Fred. These big banks and brokerage firms, it's legal, but they're not going to let you know that it is. Because the money's got to stay in the house. And it's even to a point where, like you mentioned, you can invest in publicly traded companies, mutual funds, ETFs. It even gets to a point where they don't even allow you to invest in certain ETFs, mutual funds, and publicly traded stocks. And it depends on the platform. Some are more, niched and I don't know if narrow-minded is the right term, but they don't give you as many options. It depends who your company is, who your platform is. But to me, that's terrible. We're talking about growing funds for retirement, and you're limiting. And I get it to an extent. You don't want people being crazy and going all in, everything they've saved all in on, the next Dogecoin. But they still should have the opportunity to invest their money how they see fit and with more options than not. And historically, the right alternative investment has been less risky than your traditional investment vehicle.
Yeah, that's so true.
But I'll get off my soapbox here. That's part of the reason I left that industry. So, but yeah, it's a great concept. And let's face it, Shawn, these things, they don't get taught in school. Yeah.
Right. How do you learn? It's when you, as an individual, take on and set the intention to go out and learn and pursue education. All the resources are out there. You can learn from podcasts, from webinars, YouTube videos. All the self-directed IRA custodians like to provide education for their clients so they can learn about different strategies. And so this is all available at little or low cost. And just get out there and pursue it, learn, pick up some books, podcasts. There's online content. And again, never forget about the power of connections and meeting people and building relationships.
Love it. And Fred, outside of building relationships and the networking and the conferences, obviously those are number one. That's where you're going to grow the most. But outside of that, are there any resources that you would have, like specific books or podcasts or YouTube channels that you'd have people look into on note investing?
Yeah, absolutely. There's a couple. I've written a great book about note investing called The Little Green Book of Note Investing. It's available on Amazon, and it's a great introductory overview to the business and to this asset class, and cover a lot of things from the secondary market and how to perform due diligence, how to evaluate notes, as well as a couple of chapters on how to properly structure transactions for buying notes inside of a retirement account as well. And so we really give a good high level overview for someone new wanting to learn about the business. And so that's a great resources. There are numerous conferences as well that happen around different areas of the country that you can check out. And building relationships. Again, find note investors, connect with them, reach out to them, and that's going to really serve you well no matter what you decide to do in this industry.
Yep. Oh, well, thanks for sharing that. I'm going to check that book out. I didn't know. I did read it in your intro, but your bio. But I gotta check that out because I'm intrigued.
And I'll mention another book that I really like. It's called Invest in Debt by Jimmy Napier. And that was a book that came out during the 1980s. And it's really technical as well. You would probably like that one with your financial background. But that's another book that it gets into how to use a financial calculator and running numbers on notes, and it was one of the first books I picked up about note investing.
Yeah,
so that's another resource for sure.
The 80s, the heyday of the mortgage market, right?
Yeah.
I'll check that one out as well. Thank you. And before we depart here, Fred, where can, if listeners want to find you, where can they do that?
Yeah, thank you. Best way to connect with me is to visit my website, which is fredmoskowitz.com. And if you prefer an easier spelling of that, you can go to giftfromfred.com, and that will take you right to my website. And I have a special report I'm offering to anyone that wants to request it. You can do that right on my website. I have a special report about note investing. I'm happy to send that out by email, and you can learn more. But I always invite investors, connect with me, reach out. Happy to answer any questions you have. And I always love connecting with investors, learning about different strategies that they're using. Oh, one more thing. If you prefer to text me, you can do that too. You can text the keyword money to this phone number, 215-461-4433, and then follow the prompts, and then we can stay in touch that way as well.
Awesome. Well, thanks for sharing that. I'll put that in the show notes too, so it could be easier for them to just plug and play there. But Fred, I really appreciate your time. This has been insightful for me. I'm sure the listeners have gotten a lot of value out as well. But it's powerful being the bank, and I think more people should look into being that. Not necessarily that has to be your main thing, right? But I think it's a good way, to your point, of diversifying, and getting that exposure. So, Fred, I really appreciate the time. Thanks for coming on.
Thank you. I appreciate the opportunity to come on the show, and thank you for having me on.
And listeners, as always, easy doesn't pay well, and instant gratification is self-destructive. So not only get out there and work hard for your money, have your money work hard for you, so we can all create the lives of our dreams and make this world a better place. All right, catch you on the next one.
Hey, this is Shawn Winslow. After being in the financial service industry for years and having candid conversations with good people just like you, I realized that so many of us are wanting an investment strategy that provides solid returns and consistent income without the bumps in the road. There's little known secret that your financial advisor doesn't want you to know. There is investment out there that is less volatile and the returns are stronger. Get more details by going to greenbriercg.com and clicking on the free e-report. And by the way, if this show has provided you any value, then feel free to leave an honest written review and of course share it with a friend who needs it. See you next week for another great show.